In Signal episode 7, we explored 5 smart saving strategies for 2025 from the 2-bucket rule to step-up savings. We even shared how Shalini and Rohan transformed their spending stress into a confident and structured plan for the future. And as promised, today we shift gears and look at what August AMFI data really signals about investor behavior. The message might just surprise you. We'll reveal a portfolio strategy that could completely change how you manage risk. Then we'll share the story of 3 friends, their wealth building path, their outcomes, and lessons we can take away. And finally, we'll wrap it up with a powerful quote to remind you on how to focus on what really matters in your wealth journey. So stay tuned as you may discover a new way to think about your investments. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. Sensex closed at 82,626 points, up by about 720 points from last week's close. Nifty ended at 25,327 points, rising nearly 220 points over last week. IT, realty and public sector banks led the gains this week, while private banks and FMCG saw some profit booking. Mid and small caps stayed resilient despite late week volatility. Foreign institutional investors were net buyers, supported by hopes of better global liquidity. Domestic institutional investors booked some profits but stayed net positive, helping maintain the momentum. The rupee ended near 88.09 per US dollar, appreciating slightly on softer dollar cues. So overall, a week of cautious optimism with resilient mid-caps and steady foreign investors flow kept the sentiment risk on. As promised in Signal episode 7, let's dive into August's AMFI data, which shows that equity mutual funds clocked a massive 33,430 crore of inflows, marking 54th straight month of positive equity flows. Yes, 54 months in a row. That's over 4.5 years of investors consistently buying equities month after month. And here is what stands out even more. SIP contributions held steady at 28,265 crore, which tells us that retail investors continue to stay disciplined through their monthly contributions. And which category led the charge? Flexi cap funds topped the list with net inflows of about 7,679 crore, followed by mid-cap funds at 5,331 crore and small-cap funds at 4,993 crore, displaying a clear evidence of healthy risk appetite. Even large-cap funds, which were quiet earlier this year, saw a comeback with about 2,640 crore flowing in. But here is a key signal. Debt funds saw sharp outflows of about 7,979 crore as investors rotated back into equities. Perhaps the most important data of this report was the mutual fund cash levels dropping at 5.3% of AUM, signaling fund managers are proactively deploying cash, further signaling the strong confidence in the market. So, what's the big picture? Retail investors hold steady, fund managers are deploying cash, inflows in mid and small caps remain strong, keeping the market broadly optimistic in risk-on mode. Has your portfolio drifted away from the mix that you started with? Are you thinking, what does this even mean? Imagine you started your portfolio with 20 lakh rupees with an initial mix of 70% in equity for growth and 30% in debt for safety. This means 14 lakh in equity and 6 lakh in debt. A nice balanced portfolio mix of 70:30. Fast forward few months, due to bullish market, your equity portfolio grows to 22 lakh and debt stays at 6 lakh, which means suddenly your portfolio mix isn't 70:30, it's now 79:21. Your risk exposure is now much higher than you originally planned, and most investors don't even realize this is happening because of market drift. And here is the scary part. This silent imbalance in your portfolio mix doesn't hurt in bull market. It hurts when markets suddenly decline. If markets were to fall by 20%, your originally planned 70:30 portfolio mix would drop by 2.8 lakh. A notional loss that you were prepared for when you chose that level of risk. But with a market drifted 79:21 mix, the same fall will reduce your portfolio by 3.2 lakh. An extra 40,000 that you hadn't accounted for, caused by silent, unseen imbalance in your portfolio. And that's the real problem. Your risk quietly increased without you even realizing it. And that's precisely why it hurts, because you were not ready for it. And what is the solution? Portfolio rebalancing. Portfolio rebalancing is a process of bringing your equity debt mix back to your original plan. You trim some equity, top up debt, lock in profits, and restore your portfolio mix. But why does it matter? Because it's not about predicting the next market crash. It's about controlling the risk. Rebalancing helps you book profits systematically, which means you sell high. Adds to underperforming assets during downturns, which means you buy low. Keeps your risk in check so one asset class never dominates your portfolio. As Benjamin Graham said, the essence of investment management is the management of risks, not the management of returns. So, how do you rebalance? There are two ways. One is calendar-based rebalancing and second one is threshold-based rebalancing. In calendar-based rebalancing, you pick a fixed interval, say 6 or 12 months, and then rebalance on that schedule no matter what's happening to the market. This keeps things disciplined and takes the guesswork out of timing. Whereas in threshold-based rebalancing, you only rebalance when your mix has drifted by a certain percentage, say 7 or 10%. This approach helps you avoid any unnecessary trades and kicks in only when allocation has drifted significantly. And here is where a SEBI-registered investment advisor really adds value. उनका कोई फेवरेट एसेट क्लास नहीं होता है, उनका फेवरेट होता है आपके वेल्थ की हेल्थ. They do the math, rebalance with precision, and take emotions out of the process so that you stay on track. For story of the week, let's go back in year 2000. 3 friends, Sanjay, Vijay, and Ajay, each had 20 lakh rupees to invest. Sanjay decided to buy an investment property outright with his 20 lakh rupees. Vijay built a portfolio of 70:30, 14 lakh in equity and 6 lakh in debt. Vijay has always been a keen reader and enjoys keeping himself up to date with business news and market trends. Mutual funds were new to him back then, and hence he chose to rebalance his portfolio whenever his allocation drifted too far. Ajay observed his both friends and decided to take a combined approach. He bought an investment property worth 20 lakh on loan, paid an initial deposit of 6 lakh. And with remaining 14 lakh, he built a portfolio in 70:30 mix. So 9.8 lakh in equity and 4.2 lakh in debt. Fast forward in 2025, Sanjay's property has done well. The current valuation of his property is between 80 lakh to a crore. Now that's the upside. Steady growth and comfort of owning a tangible asset. But here is the challenge. If he needs access to 50 lakh rupees right now, he will need to sell his entire property. He just can't sell a part of his property, which means paying capital gains tax on full amount and going through entire sales process even if he doesn't need to access all the money. And yes, he's talked about his struggles with bad tenancy over the years. But we'll leave that aside for now. The point is, all his wealth is concentrated in singular asset class, which leaves him completely exposed to property market cycles. And Vijay's portfolio that he started with 20 lakh as well has compounded and is now valued between 3 to 3.2 crore. And that's the upside. Steady compounding and much smoother wealth journey, thanks to his disciplined habit of reviewing and rebalancing on a regular basis. A few years later in his journey, he associated with a SEBI registered investment advisor who helped him rebalance his portfolio professionally, take emotion out of his decisions, helping him stay focused in his long-term wealth journey. Ajay's combined approach has done well too. His property is worth 80 lakh plus and his mutual fund portfolio is between 1.5 to 1.7 crore today. But here is the difference. Ajay never rebalanced his portfolio. Over the years, his equity exposure has drifted too high, making his journey very stressful. So what do we learn from these three friends? Sanjay shows us that concentrating all your wealth into one asset limits flexibility and control. Ajay shows us that diversification and discipline is good, but without proactive management, you can still experience stress and lower outcomes. Vijay shows us power of rebalancing and how working with a professional can make your investment journey systematic and stress-free. Rebalancing helps you trim exposure when markets run hot, add more when markets are down, and keep your portfolio aligned to your long-term goals, just like Vijay did. That brings us to the powerful reminder from Benjamin Graham, father of value investing. The essence of investment management is the management of risks, not the management of returns. Too often investors chase returns and let their portfolios drift or try to time the market based on greed and fear. And this is where getting help from a professional can make a real difference. A SEBI registered investment advisor can take emotion out of the process, rebalance your portfolio systematically, and help you stay focused and disciplined. But smart investing isn't about chasing the highest return. It's about controlling risk. We are building a strong community of robust, receptive, and resilient long-term investors. If you're one of them, why not like and subscribe us and tell us in comments when was the last time you checked your equity debt mix?